There are moments in the market when staying silent is more dangerous than being wrong, and this is one of those moments. Because while most investors are still focused on what to buy next, the biggest risk right now is what they're still holding. For decades, the winning strategy was simple: buy great businesses, ignore the noise, and let time do the work. Low interest rates, easy money, rising asset prices, almost everything went up. But that world no longer exists. Interest rates are no longer near zero. Debt is no longer cheap. Commercial real estate is cracking. Banks are under pressure. And yet, many stocks are still priced as if nothing has changed, as if the next few years will look just like the last 10. That disconnect is where real danger lives. Because when the environment shifts this fast, some stocks don't just underperform, they break. They fall not by 10 or 20%, but by 50, 60, even 70%. Wiping out years of progress for investors who never saw it coming. And this isn't about guessing the next crash or panicking out of the market. It's about recognizing red flags early, the same types of warning signs that historically show up before major collapses. In this video, I'm going to break down 5 categories of stocks that are flashing serious danger signals right now, why they're uniquely vulnerable as we head toward 2026, and how beginners can think clearly about risk before losses spiral out of control. But before we get into which stocks matter and why, you need to understand one uncomfortable truth about market cycles. Because once you see it, holding the wrong stock becomes far more dangerous than sitting in cash. Let's start there.
I've been investing for decades, and I've learned something that most people only learn the hard way. Markets don't usually break when everyone is scared. They break when everyone feels safe. And right now, what worries me isn't just one headline or one economic report. It's the combination of 3 forces that almost never show up together like this. First, interest rates. For more than a decade, money was cheap. Companies could borrow at 2% or 3% and look like geniuses. But now, rates are above 5%, and that changes everything. Debt that was manageable becomes a trap. Second, valuation. A lot of stocks are still priced like we're in 2020 or 2021, like money is free, growth is guaranteed, and risk doesn't exist. But valuation always matters eventually. It might not matter today, but it always matters later. And third, refinancing risk. A massive amount of corporate debt and commercial real estate debt was issued in the last 5 to 7 years, and a lot of it comes due in 2025 and 2026. That means businesses and property owners will have to roll that debt at much higher rates, or they won't be able to roll it at all. So this video isn't about fear. It's about avoiding predictable mistakes. Because in every major market cycle, the biggest losses don't come from bad luck. They come from holding the wrong kinds of stocks at the wrong time. Stocks that look fine on the surface, but collapse when the environment changes. That's why I'm going to walk you through 5 categories of stocks that share one thing in common. They depend on conditions that no longer exist. And if you understand that, you can protect your portfolio before the crowd realizes what's happening.
The first category of stocks I would seriously question holding into 2026 is in profitable technology companies, especially in artificial intelligence. Let me be clear, artificial intelligence is real, it is powerful, and it will change the world. But history teaches us something uncomfortable. Most investors lose money in revolutionary technologies. Right now, there are dozens of AI companies with billion-dollar valuations that don't make profits, burn massive amounts of cash, and depend on constant fundraising just to survive. When money was cheap, this wasn't a problem. Investors were patient. Capital was everywhere. That world is gone. At interest rates above 5%, capital is selective. Investors demand real earnings, not promises. Here are the warning signs. Market value in the billions, revenue in the millions, losses growing faster than sales profitability, pushed further into the future every quarter, heavy reliance on 1 or 2 major customers' management teams with no experience running profitable businesses. These companies are priced for perfection, and perfection almost never happens. When funding slows, these businesses face brutal choices: dilute shareholders, cut growth, or fail outright. Most will not survive intact. If you own speculative and profitable AI stocks, especially smaller names, the risk is asymmetric: limited upside, massive downside. That's not investing. That's gambling on hope. The second category is office-focused commercial real estate and REITs. This is not a cyclical downer. It's a structural shift. Remote and hybrid work permanently reduced demand for office space, and that demand is not coming back. Across major cities, vacancy rates are near record highs. Rents are falling, and refinancing costs have exploded. Many office REITs borrowed heavily when rates were low. Now those loans are coming due at double the interest rate. In many cases, rental income can no longer cover debt payments. This leaves REITs with terrible options: sell properties at huge losses, default on loans, cut or eliminate dividends, or dilute shareholders. High dividend yields are a trap here. They are not sustainable. The math no longer works. And because office leases expire slowly, the worst effects are still ahead, not behind us. This sector will take years to reset.
The third category I would be extremely cautious about going into 2026 is heavily leveraged companies, especially in industries facing structural pressure. Debt is not just a number on a balance sheet. Debt is a timer. When the economy is strong and interest rates are low, that timer feels harmless. But when rates rise and refinancing gets expensive, that same debt becomes a trap because it removes flexibility. Here's the math that most investors ignore. A company takes on debt because it believes it can earn more on that money than it costs to borrow. That works when borrowing is cheap. But over the last few years, we moved from a world of near zero rates to a world where refinancing can cost 6%, 7%, even 9%. And that change breaks business models. A company that could comfortably service debt at 3% can become stressed at 7%, even if revenues stay flat. Because the interest expense doesn't care about your story, your brand, or your long-term vision. It's cash. It's due. On schedule. Now at a second problem, structural headwinds. The most dangerous setups are companies that are both highly indebted and operating in industries where demand is slowly being eaten away. Think about traditional retail chains that keep losing customers to e-commerce. Think about legacy media companies losing advertising and subscribers. Think about certain telecom and cable businesses with huge infrastructure costs and weakening pricing power. Or travel businesses that borrowed heavily to survive the pandemic and now face higher costs, tight margins, and unpredictable demand. Here are the warning signs you can spot quickly. Debt to equity that looks stretched compared to peers. Interest coverage that is thin, meaning earnings barely cover interest costs. A refinancing calendar where large portions of debt mature in 2025 to 2026. Declining margins, shrinking cash flow, or repeated one-time adjustments. Management emphasizing growth while quietly avoiding direct debt questions. And here's what happens when the debt cycle turns against them. First, the company refinances at higher rates. Second, cash flow gets squeezed. Third, they cut investment, which hurts competitiveness. Fourth, revenue weakens. Fifth, the market loses confidence. And once the market loses confidence, raising new capital becomes either extremely expensive or impossible. At that point, shareholders are no longer owners of a compounding machine. They're the last line of defense protecting creditors, and the last line is usually the one that gets wiped out. This is why I treat heavy leverage like fire. It can warm a business in good conditions, but it can destroy it when the environment changes. If you're holding companies with high debt and fragile industries, it's not pessimism to reduce risk, it's discipline.
In today's highly volatile financial market, investing in speculative and meme-driven stocks can be particularly risky, especially for beginner investors who are still learning to navigate these unpredictable conditions. These investments are characterized by extreme price swings and valuations that are often driven more by social media hype and viral trends rather than solid company fundamentals or proven business performance. Speculative stocks represent high-risk ventures, typically from emerging companies that have little to no earnings history or tangible assets to justify their lofty market valuations. Meme stocks, on the other hand, gain massive popularity through online communities on platforms like Reddit, Twitter, and Discord, which can lead to unpredictable and rapid price surges fueled by collective enthusiasm. A major risk is high volatility, where stock prices can soar to incredible heights or plummet dramatically in very short periods, making them entirely unsuitable for investors seeking stable, long-term growth. Many of these stocks completely lack the financial performance metrics needed to justify their inflated valuations, creating a significant and dangerous disconnect from their true underlying economic worth. This speculative environment makes them highly susceptible to market manipulation, including notorious pump-and-dump schemes where prices are artificially inflated by promoters before a rapid and coordinated sell-off crashes them. Liquidity issues can also arise in these stocks, making it extremely difficult to buy or sell large quantities of shares without significantly impacting the stock's price in the process. Real-world examples like GameStop, AMC Entertainment, Bed Bath & Beyond, BlackBerry, and Nokia perfectly illustrate just how quickly these meme stocks can experience dramatic rises followed by steep falls. Social media platforms play a crucial role in this phenomenon, amplifying hype through viral posts and creating an intense sense of urgency among potential retail investors. Psychological factors such as FOMO, greed, and herd mentality often drive emotional investing decisions, overriding rational analysis and sound judgment. Beginner investors are particularly vulnerable to these traps due to their lack of market experience, limited capital resources, and heightened susceptibility to emotional appeals from online communities. Instead of chasing these risky bets, consider safer alternatives like diversified portfolios, which effectively spread risk across a wide variety of asset classes and sectors. Index funds and exchange-traded funds, commonly known as ETFs, provide broad market exposure with lower costs and are generally much less volatile than picking individual speculative stocks. Bonds and real estate investments can also serve as more stable options, offering predictable income streams, tangible value, and generally lower risk profiles for conservative growth. It is absolutely crucial for all investors, especially beginners, to conduct thorough research and rigorous due diligence before making any investment decisions in today's complex and fast-moving market. Truly understanding the underlying value and fundamentals of a company, rather than chasing fleeting social media trends, is the key to achieving sustainable long-term financial success. By always prioritizing informed, research-based choices and wisely avoiding the seductive allure of quick gains, beginner investors can steadily build a more secure and prosperous financial future.
Let me leave you with something that matters far more than chasing returns: protecting your capital. After more than 70 years of investing, I can tell you this with absolute certainty. The worst mistakes are not the opportunities you miss. The worst mistakes are the permanent losses you fail to avoid. The 5 categories of stocks we discussed share one dangerous trait: they expose investors to irreversible damage. These are not temporary drawdowns. These are situations where capital disappears and never comes back. Unprofitable AI companies burning cash. Office-focused real estate collapsing under structural change. Heavily leveraged businesses refinancing debt at double the cost. Speculative meme stocks detached from reality. And vulnerable banks exposed to commercial real estate and fragile deposits. None of these risks are theoretical. They are already unfolding. Now here is the important question: what should you do instead? First, understand that holding cash is no longer a failure. With interest rates elevated, cash earns a real return. More importantly, it gives you flexibility. When assets reprice and fear returns to the market, liquidity becomes power. Second, focus on quality businesses. Companies with strong balance sheets, low debt, consistent free cash flow, and pricing power. These businesses may not be exciting, but they survive downturns and compound quietly over time. Third, favor durability over narratives. Look for companies that sell essential products or services that customers continue to buy even in difficult economic conditions. Businesses that do not depend on cheap money or perfect execution to survive. Fourth, remember this: you do not need to be fully invested at all times. Some of the greatest long-term returns are generated not by action, but by patience, by waiting for the right moment instead of forcing decisions in dangerous environments. Markets move in cycles. Excess always corrects itself. The only question is whether you will still have capital when opportunity returns. Selling risky positions before 2026 is not pessimism. It is discipline. It is understanding that survival comes before growth. If you protect your downside, the upside will take care of itself. And that mindset, not speculation, not hype, is how real wealth is built.